I used to think that if I just knew the right technical pattern or the right technical system, then it would work for me across every single market. And so therefore, because of that belief, the market that I picked didn't really matter for my results at all. And so this is the biggest reason why I only traded FX for 5 years. But when I switched to stocks, which happened over time, everything became 10 times simpler, easier to read and to understand. Trends were cleaner, the moves made sense, and the opportunities were constant. And this is something that you cannot do with FX. I know that most of you watching this probably have come from an FX background in some way or another, but even if you haven't, this is still going to be relevant for you. So let's get into details on the actual problem of what I'm talking about and why this is the case. So one of the realities of the trading world is you'll find that some of the best traders ever all have one thing in common, and that's that they are usually trading trends. But the problem is that the market you pick determines the amount of trends you're going to have access to. And the FX markets are notorious for not being trending markets overall. This is important because of one simple thing. The markets are typically in two main states, may come in different shapes and sizes, but for the most part, we're either consolidating, so going sideways, or we are in a trending phase. Now, the trick is that when we are transitioning from one state to another, this is where most systems will experience some sort of transition or some sort of loss. This is just the truth of life, because the types of systems that work in this environment are not going to be the same type of systems that work in this environment over here. And so unless you have some sort of element in your system that allows you to predict when these things are going to happen, if you don't have that, you are essentially reacting. Like most technical only systems, you are reacting to what has already happened. And that means that the only way you're going to know that your system is changing is when your system stops working, which means that when you experience losses. And so if you have a system that is designed to work well in a consolidation, typically that means that you are looking to buy lows and sell highs to some degree or another. For example, you'd be looking to buy around there, looking to sell around there, or if prices went a little lower, you'd be looking to buy around there. If they went a little bit higher, you'd be looking to sell around about that there. That's the general idea. But let's just say that we then began to break down really aggressively, or even just a slow grind down, and we continued with that attitude. We're going to realize not until a significant period of time has passed, obviously depending on the rules and the system, that system has stopped working. And so that may just be an extra 2 or 3 losses, maybe it's 4 losses, maybe it's 5 losses. But the reason that it's important is because when you are trading this type of a system, because it's not designed for a trend, what it means that your risk reward is normally going to be smaller. It's a general rule that if you are mean reverting, you're typically going to be playing at like 1-to-1, maybe 1-to-2 at a push. There are obviously going to be so many variations, but as a general rule, the more consolidation focused your system is, the lower your return is going to be for the amount that you risk. And so what that means is it means that the value of losses has gone up in your system. And you might not think that this makes a big difference, but over time, this makes a huge difference. And so every single time that you have a change in market condition where we go like this and we're shifting from sideways to going, for example, aggressively down, it means that you are essentially stacking up these extra losses. Even if overall you made enough during here, these transition periods are where you are going to be giving most of your money back. Now, why is that important? Well, because if you've picked a market that is designed and functionally always tends to move like this, where it's very choppy, the trends don't happen as often. When they do, the trends aren't as big. What that means is you're getting more of these transition periods, and not just that, but you're more sensitive to the negatives of those transition periods. Meaning when we transition, the amount of losses we get goes up, and the effect of those losses on our overall equity curve, meaning our overall performance, is even more extreme. And so this is another way of saying that when you aren't trading a trend system, when you're using mean reversion, you don't have as much of a buffer, meaning you don't have as much of a safety net. If we compare this to a trending system in a trending environment, obviously if we apply a trending system to a non-trending environment, then we're going to run into kind of our own sorts of issues. This actually flips on its head, because by the time you get to a losing period, and we'll draw out an actual proper example, let's just say we have a nice trend over here, and then we start kind of going sideways like this, then we start kind of going back and uncertainty hits. During this period, if we've done our job correctly, we're letting winners run, we're probably trailing our stop a little bit, scaling in if that's part of our plan. Again, we don't need to get into the specifics because it's not ultra important to illustrate the point here. But essentially what we have is we have a time where our return is obviously much higher than our risk. Now, this may sound really beginner and really obvious. However, it's important to understand the nuance here, because as we continue to trade this in whatever way that we do, whether you go break even, all these other sorts of things, the point is that when things begin to shift, assuming you've got no way of predicting it, which there are ways depending on the market, more on that in a minute, is when you do eventually get to one of those transition points, you have much more win accumulated to absorb that loss. That is extremely significant when you are looking to be a trader over the long run and not just trying to make loads of money this month and then, forget to the next month or the month after that. If you want to be in this for a long time, you need to understand the type of trader you are. It's not to say that trading a mean reversion system can't work. I've traded a mean reversion system and many before. The point is that it puts more strain on you needing to be right. And in the context of FX, it's also a double whammy, because what happens is this market is not predisposed to trend, because the purpose of the FX markets is typically price stability. And the factors that drive the market are very, very different to what would drive, for example, stocks. So then the question is why did I move mainly to stocks? So the first reason that I have moved towards stocks is, first of all, business is really simple, right? If a business grows over time, the idea is that the stock will rise, obviously. And over time, if a business shrinks, then the stock will fall. Now, of course, there's some nuance to this, but at a basic level, this is something we can all understand. And if we remember how the S&P 500 looked over time, you will remember that it just goes up and up and up and up like this. Why is that? Well, it's because the overall economy should grow. Businesses look to make more money, more profit, and over time that's expected to grow and grow and grow and grow. So in simple terms, what does this mean? Well, it means that the overall market itself has an overall directional bias. In other words, a trend built into it. This is why in the investing space, you will hear people say, just buy the S&P 500. It's a great investment. It's simple. You don't need to time the market, any of that sort of stuff. And that's good advice. And so this is important to understand, because if we did nothing else and we understood the benefit of trend trading, and again, this is not me saying that mean reversion systems don't work. I've traded mean reversion systems myself. It's just the highest return I have found has come from trend systems typically. And so if we did nothing else and just listened to that, it means that the US stock market in particular is a much better vehicle to use trend following systems on. That's the first thing. But luckily, it actually is even better than that. So let's break this down. The second one is there's more opportunities. So if we look at FX pairs, for example, let's just say, there's about 30 pairs. There will be more than this, depending like what you define as a valid pair. You could, if you're combining like really wacky currencies, but for the most part, it's going to be kind of 30 or less pairs that we're actually looking at. That's actually not that many potential markets, because just because you've got 30 on your list doesn't mean that 30 are ready. It's often a much, much smaller amount. And to give you an idea, in terms of things that actually cause lasting trends in the market, you're typically going to be looking at about 2 to 4 major positions over the course of a year. Now, this, of course, is based on what an institution would look at. So this is not going to be pure technical systems, but that's a small amount nevertheless. If we compare that to the US stock market, we have 1,873 stocks, I believe, that are above $1 billion in value. And so that's a massive universe to begin with. And then from that, if I use me as an example, what I'll do is I'll refine that using a very specific, like institutional level process into a weekly watch list. So these are stocks that have an actual reason to go up and an actual reason to go down, which filters that universe into 20 to 30 stocks I can watch each week that have an actual bias behind them. And then all I need to do is time it technically. That's how I like to do things now. It makes my job very, very simple. So this is an example of the watch list that I send out once a week to the Inside Alpha group. It's essentially just the stock, the sector, the bias, whether it's predisposition to go up or to go down, an example of the chart, the story strength, the momentum state, all based on my proprietary process. And so this makes things very easy, because then all I'm looking for is a very simple two-step entry trigger to actually get involved in the direction that my bias has already done. If you want to learn more about that, you're more than welcome to check out the link in the description box below. If not, that's absolutely fine as well. You're more than welcome to go do your own research, build your own system. I encourage that, do that, it's fantastic. Anyway, so more opportunities. Next thing is less transitions. So this is a huge one. Remember what we spoke about with FX, right? The transitions from sideways to trend happen all the time. And the more transitions you experience, the more you are going to suffer from the reactionary effects of a system. If you're trading a sideways pattern, like buying support, selling resistance, when we start breaking out of that consistently and you're still buying, even if it's just an extra 2 or 3 times and losing, what that means is it means that you are, all those little extra losses that you're adding will affect your overall P&L more over time, because your losses are a similar size to your wins, which means that they have a bigger effect. It's the same idea that if you lose 50% of your trading account, you need to make 100% to get back to where you started. And that shows you the nature of how just losses on their own can be massively over time more influential than the wins. And so what does this mean? Well, it means that less transitions means less friction with what we're doing, less opportunities for you to need to give back money to the market. It's also another reason why it's important, ideally, to know the drivers behind price, not just react, because you're actually able to predict when those transitions may be coming. Doesn't mean you'll do it every time, of course, but it just stacks the deck in your favor just that little bit more, which is really important. Anyway, so then we have bigger moves. So higher return, bigger safety net. So the stock market is just more volatile, meaning it moves more. You can see this, especially compared to FX. FX doesn't actually move that much. Like if we just look between beginning of 2023 to mid 2024, we were operating within like a 6.4% range. If we compare that to the S&P 500 start 2023, so we look at that from there to about mid 2024, about September I think it was, we had a 45% rise and trend during that exact same period. That is a vast difference. This is before leverage, any other kind of technical timing tools that we add. And so this basically is just another factor saying, look, the actual environment that we are wanting to be in is significantly different. And so all of these things combined basically just lead me to the inescapable conclusion, and have led me to this conclusion, that for the best results for what I want, which is a trend following system at this point in time, where I can make the most for the least amount of risk possible and get the most opportunities without trying to squeeze, my opinion on the chart and all this sort of stuff, the stock market, particularly the US stock market at the time of recording this, is my absolute favorite. It's what I much prefer doing. It gives me a broad range of things that are going on. And if I do want to understand more about something, more about a company, that's much more interesting as me, which is just a side bonus, interesting to me, sorry. That's much more interesting than looking at the macroeconomics of a country and understanding the interest rates and the differences between them and all of the factors that influence an overall economy. Whilst I understand that stuff really well, I'm not passionate about that at all. Like, it's pretty boring. And so for me, it's a blend of the practicalities, but as a bonus, it's actually more fun as well. At least that's my opinion and my experience. So that's just my 2 cents. I hope you've enjoyed. I'll leave a video that you might enjoy in the description box below and on screen right now, and I'll see you there. Take care.